So I have an amazing special guest with me today, Colin Lloyd. He's been following financial markets for over 30 years. So his insights are tremendous. They go back for many, many crises, not just throughout the new millennium. So his expertise throughout all of financial markets and the overall global macroeconomy, it's greatly appreciated. And I'm really happy to have you on.
Well, Max, thank you very much indeed for taking the time. Uh, Maybe give you a bit of background as to how I came into the financial markets, slightly from left field. I began my career way back at the beginning of the 1980s in the commodity markets. I was involved in shipping uh, boatloads of timber, softwoods, hardwoods, that kind of thing, from one place in the world to another place in the world, chartering ships, doing bunkering in those days. Back in the 1980s, we were just heading into the second oil crisis, and so we were trying to negotiate bunkerage out in the Middle East when we were taking stuff, say, from the Far East to Europe or even to the US. It was a fascinating business. It was a family business, but it was getting marginalized. And I realized that there were more efficient markets out there, and I had a hankering to be involved in the financial markets kind of area. So I moved in 1987 into the financial futures and options world. There was a choice between doing that and going back into commodities, but I could see what was happening with the commodity cycle. It was just heading into its downturn. Gold had peaked and was heading lower. So I came into financial futures and by sheer dumb luck ended up talking to some people who turned out to be among the most interesting global macro hedge fund managers in the world. Um, Rather be lucky than smart, as they say. And that's really where I learned about macroeconomics, applying what I'd learned from being in the physical commodity business. And you learn a lot about business in general in that kind of environment, and then applying it to the financial markets where everybody who's been in the business 5 minutes talks about what the Federal Reserve are doing as if they know what they're talking about. And it takes them about 10 years to learn that they've been looking through a glass darkly.
Right.
So financial futures was my kind of first thing. Got involved in interest rate swaps and some over-the-counter products. Um, Midway through having sort of developed that business, I got the opportunity to move into equities. All of this from the sell side, if you like, from the brokerage side. Developed a prime brokerage business. In 2006, did a kind of an about face and moved on to work for a global diversified systematic hedge fund that was trading, if you like, a kind of systematic macro strategy, and got involved in talking to investors from that perspective. Um, all this time, there was that interest in financial markets and writing about them both internally and externally. I mean, back in, I guess, 93, 94, when Bloomberg brought out their kind of messenger service, I started writing a daily comment to one of my clients. And then my colleague said, "Oh, could we add another client to that?" And I then found out about how you blind carbon copy somebody. Ended up with about 150 macro hedge funds reading this comment on a daily basis. I didn't know I was a blogger. I don't think anyone had invented the word blog at that stage. Um, in the equity space, and when I was working for the hedge fund up until 2010, I took my foot off the pedal in terms of writing. Then I started a business in foreign exchange, 2010, 2011. And as part of that, we needed some research. And so I went back to my macro roots and started writing a comment for the clients that we were covering at that time. And when I sold out of that business in 2013, I started my global macro newsletter, which is in the long run. And I guess that's the story of how I got to there. Since then, I've been writing about the markets from a much longer term perspective. So I don't give you, the tip for what might be coming up next week. It's more about the big picture of what things are going to look like, 5 to 10 years down the line, which is difficult because there is always so much uncertainty. If you look at someone like the IMF, they make their global forecasts for GDP growth, and more often than not, they're wrong. It's not their fault. They've got some of the best modeling capabilities in the world. It's just that trying to forecast economies is an incredibly difficult problem. So there you go. That's my background.
Right, absolutely. That's one extensive background. I mean, it's really fascinating that you've been around all areas essentially of financial markets. I mean, from interest rate swaps to were you personally involved in gold and silver, or was it a broad basket of commodities?
Broad basket. Did some trading in COMEX gold. I'm working with some guys at the moment who used to trade spot bullion as part of their foreign exchange capability. One of my good friends is in the business of uh, leasing gold. So I'm kind of familiar with that area as well. Uh, Things that I'm interested in now, I'm extremely interested in the development of the digital asset space uh, and everything that's happening there. It's certainly going to be interesting to see how fiat currencies cope with the arrival of something that looks like the next iteration of gold, which has been the source of value, source of safe haven for maybe 5,000 years.
Right. And it's also fascinating how people put a name tag of safe haven on something that has 10 years of history, not even something like Bitcoin. Since in 2017, they called it a safe haven. And this year and currently, they're calling it a safe haven once again. I personally find it unfathomable how that's possible. And I've never known a safe haven to have intraday, swings of 10% or more. Right. I mean, gold doesn't move rarely over 3% usually. Silver is
Yeah, I mean, this is one of the problems. Yeah, the cost of mining a new Bitcoin makes a sort of an economic floor under the price to some extent. But and it's supposed to have never ever more than 21 million coins once they've mined all that they can. Um, there are a lot of issues that need to be addressed. Security, safe custody, these sort of issues are still out there. But I think it's something to watch, and it isn't going to go away. And the underlying technologies are also fascinating. The distributed ledger technology, which has been around in one shape or form since the early 1990s, finally came of age in 2008 and has not looked back since then. And I think the digital transformation that we're seeing since COVID is sort of interlinked with these other trends, which I think will continue for several years.
So do you believe that there's a common use, because a commodity in my eyes is a combination of use value and consumption. That's what comprises a commodity. Yeah. But how can that be comparable to digital gold, or whether it's digital pork belly or iron ore? How is there a common use and consumption value between all of these quote unquote commodities?
Uh, if we're thinking about the sort of digital asset market, obviously that's something like Bitcoin is an alternative to a fiat currency. What does the currency have? It has a convenience as a means of exchange, and providing it isn't being continuously and deliberately debased, it provides a store of value. The the argument for fiat currencies is that they are supported and backed by the tax raising capabilities of the various governments. But that then takes us into the question of whether interest rates on 10-year government bonds, some of which are quite substantially negative at this time, whilst real inflation is probably running above what harmonized indexes of consumer prices tell us, whether the store of value is really there. Commodities I mean, gold as a commodity is more used as a store of value, except perhaps in its use in jewelry. Other precious metals are a rather different matter. But digital currencies taking over from fiat currencies, I don't see that happening. But I do see many of those technologies changing everything. I wrote recently about central bank digital currencies, and one article that I wrote for American Institute for Economic Research. And there I'm thinking about what the implications are for the whole banking system. Right. Come the next crisis like 2008, I think a lot of people would have kind of liked to have had a personal bank account with the Federal Reserve, because you didn't really know if any financial institution beyond one that was entirely guaranteed by the government was going to survive. The arrival of central bank digital currencies could cut out the middleman altogether, but it comes with a lot of implications. So I think that's going to be a really interesting space to watch, which is one of the reasons that I'm interested in the whole digital currency space. I should add that I wrote about digital currencies first when Bitcoin hit $35. Wow. More fool me, I didn't buy it at that point.
Not many people did.
No.
So I wanted to also ask, in your website, inthelongrun.co.uk, and by the way, we'll have all your information down in the description, so people can view your work and your research. But specifically in your latest macro letter, you mentioned who I've never heard of before, honestly, Richard Cantillon. Did I pronounce it correctly?
Cantillon.
Cantillon.
Yeah. Yes, an itinerant Irishman living in France in the latter part of the 17th century. What he observed was that when currency is being created, and in this case it was the French forerunner to the central bank, the people who are closest to that kind of minter of new money benefit most, and the people at the bottom of the food chain, so to speak, the agricultural laborer, lost out because the price of everything they wanted to buy had already gone up. And this was an early example of the kind of the way debasement doesn't evenly affect everybody. The first, another example of this is when Cortez and his followers started developing the Americas. There was this enormous influx of gold and silver from the New World, which initially benefited the Spanish and the Portuguese, but eventually led in many ways to their eventual demise as the more mercantile economies of the UK and the Netherlands gained preeminence. So the counter-on effect is something that you look for. At the moment, what I'm seeing is that there's been a massive increase in money supply. There's fiscal spending, which is a little different from the quantitative easing that we've seen over the last 10 years. It's got a more direct effect, although the people who are in the business of building new bridges for the government are going to benefit more than the average sower of corn in Iowa. So again, it's going to have uneven benefit. But that process of debasement means that inevitably the price of things will start to rise. And what are we seeing? Well, we're seeing the price of equities rise as a result of that. This has been the solution since very clearly since 1987. Every time there's a crisis, every time the stock market drops, the Federal Reserve and then other central banks, and now the governments as well, come in and bail out the owners of stocks. It's not because they love the owners of stocks, it's because otherwise you end up with a massive recession. But of course, the longer you spend propping it up, the worse the eventual reckoning is going to be.
Right.
The only question is how long it's going to be before that reckoning occurs. But a lot of people said, "Oh, well, that'll be it after 2008." And I said, "Well, look, this is the first time we've had a concerted, a concert party of central banks all working together. The last 5 crises, the Federal Reserve saved the planet single-handed. Well, I reckon they've got another 3 or 4 bites at the cherry before they've run out of ammo on that one. So, not this crisis, not the next crisis. And we got through 2008. We've just got through COVID, and it always looks like a blink. And now the stock market's even higher. There's something fundamentally wrong with it from a sound money puritanical point of view, but that's the world we live in, and that's kind of what I write about in my macro newsletters. It's not really how the world should be. It's more how at least the financial markets are, and how that may seem divorced from reality, but actually there's a connection there.
Right. I certainly do agree with you, in part because, these modern monetary theorists are just growing in size as time goes by. In fact, I don't think we've ever seen more promotion for Keynesian, neo-Keynesian modern monetary theorists surrounding the entire globe, because central banks around the entire globe, like you said, to your point, are just pumping liquidity into the system. And something that we talk a lot about on this channel is, the tools, the dual mandate that the Fed has, is maximizing unemployment and overall price stability. But to the degree that not just the Fed, but the UK, the BOJ, the EC, all these central banks have been, tremendously leveraging up, causing corporations to lever up. And thus the average American is levered up on debt. So the wealth gap, and I saw an interesting fact the other day, I believe it was from Forbes, that 70% of the population, the world's population, has $10,000 USD, 70% of the world population. And when I saw that stat, I immediately took blame on central banks and the federal government, because I believe that's the reason why we're seeing this wealth gap, as well as, the money printing, I believe, is something that's more of a wealth transfer. It's not necessarily, something that's tangible or physically done, because the Eurodollar market in itself, it's something that nobody really knows about, and it's potentially 10, 20 times the size, the monetary base. So I'd like to get your view on, how the Federal Reserve, or rather how central banks kind of collateralize themselves upon more debt. It's a very complex kind of system that they've made it become, when it could have been very, very simple from the beginning.
Yeah, there's George Solgan and some of the other guys from George Mason have a kind of thing called the Sound Money Project, which is all about getting away from this. At its ultimate, you'd get rid of the central bank, and you'd still have cycles, but they'd be much less extreme. Part of the problem of the central bank as a lender of last resort is basically there's a conflict of interest there, and there's moral hazard, because I think it was Andrew Carnegie many years ago who said, when you owe the bank $50,000, you have a problem. When you owe them 5 million, they have a problem, because back then 5 million was a lot of money. Essentially, one of the things that was supposed to happen after 2008 was get rid of the too big to fail problem, instead of which, with interest rates at rock bottom, it's cheaper to issue debt than equity, but it's much more difficult for a small company to issue debt than it is a large company. And so the big companies that should have gone bust because interest rates put them out of business aren't put out of business because they're allowed to hang on and limp on life support. You end up with, therefore, no new businesses being created, because the gap in the market that should be there for the creative destruction that Joseph Schumpeter wrote widely about doesn't happen. It all gets postponed, and you end up with a moribund economy that can't generate any growth because there are too many companies that shouldn't be around. And if interest rates were fairly priced, they wouldn't be. But the reason that interest rates are where they are is because the central bank drives that interest rate to a level which is unrealistically low. The counter argument is that that's the function of the central bank to support the market in the downturns and take away the punch bowl when things get a little overheated. The trouble is that every time they look to take away the punch bowl, since Paul Volcker, I haven't seen a Fed chairman or indeed any other central banker who'd stick his head above the parapet and do that. And if they did, they'd be shot down by the elected politicians, who would immediately question whether they should be allowed to have that independence. They're allowed their independence because they save the elected representatives from the embarrassment of a terrible recession or a depression. It's creating a situation which is vastly more complicated than it should be, as you say.
Right. And
but I don't think it's going to change overnight. I don't think we're going to get rid of all the central banks. There are ways we could get there, but I don't think anybody's got the political appetite to do that. We're saddled with that because we're democracies. What was it Churchill said? Democracy is the worst possible system, except when you compare it to the alternative. Something like that.
Right. Yeah, that's a very good point. And I know inflation expectations, they've recently really started to climb. I think currently at 3%. And some people say that inflation expectations actually drive inflation. But with M2 velocity, basically at 1, which is still above a lot of other sovereigns, but it's extremely low, as well as, so I'm blanking out on the other thing, but there are some signals that do suggest not necessarily a reflation kind of scene, but more of a deflationary kind of scenario, because if you've ever have you heard of Brent Johnson's dollar milkshake theory? It basically suggests about sucking up of liquidity from the Federal Reserve, from commercial banks to the Federal Reserve through this asset swap, otherwise known as QE.
Yeah, I haven't heard the phrase, but I know what you're talking about. Yeah, the whole inflation, deflation, reflation argument, discussion, debate, it will continue, I think, for the next few years. Since 2008, we've seen a lot of people get back into employment, but the kind of employment that a lot of those people are in is a lot less certain than it was prior to 2008. The weakening of global economies as a result of the COVID crisis will just accelerate that trend. Meanwhile, on the other side, you have robots taking over all sorts of roles. There was a very good piece by McKinsey on the number of jobs that could be done in an automated fashion, which is great news in the long run for the human race, because we'll all have much more interesting jobs to do, and the boring and repetitive stuff will be taken away. But in the transition from where we are now to there, there's going to be a massive number of winners and losers, and probably initially a lot more losers than winners. So there's all kinds of headwinds that mean that the inflation in consumer prices that you might expect are curtailed. People haven't got enough savings to retire. Everybody's living longer and therefore need to save more before they can retire. Currently, because there's nothing to spend your money on during lockdown, saving rates have increased. But even when they go back to normal, I think that those saving rates are going to be higher because people are feeling more and more vulnerable about where their income is going to come from and how long that job is going to last. In that environment, it's unlikely that you're going to see consumer price inflation. But meanwhile, all that liquidity has to go somewhere. So instead of getting consumer price inflation yet again, you're getting inflation in liquid asset prices, aka the stock market.
Right.
Obviously, there are other investment opportunities which are also doing well, because every time stocks go up, big pension funds are saying, well, we now need to get a rate of return of 8% on our capital. And with these stocks with a PE of 20 something, it's unlikely over the next 10 years they're going to deliver that. So they take the money out of stocks and put it into private equity. So the private equity keeps going up, and private equity is a wonderful place to be, because with interest rates where they are, it's much cheaper to issue debt than equity. So you take that equity, you lever it up with debt, and you generate your 25% annualized return on capital. It's one massive financialization. Well, the financialization of the economy has been going on since probably the breakdown of Bretton Woods in 1972-3, and it's just accelerating.
Right. And to your point,
I think it's bad, but that's the way it is, and I don't see it changing. So, as I say, what I write about is how things are, not, what would be sensible.
right. Absolutely. And I mean, all these manias these manias that are taking place left and right. You have the Tesla mania, you have the Bitcoin mania, you have the Russell 2K mania. It's all over, and it's only getting more saturated. ETF inflows are just continuing to surge higher. Maybe it's getting transferred from one sector of the economy to another. But it's just, it's unbelievable what's happening. The amount of speculative nature, and then you have net shorts on the 30-year at record highs, and record high net shorts on the U.S. dollar. It really, the positioning across financial markets right now is it's quite fascinating to see.
fascinating and frightening at the same time.
Right.
You got two things there. You've got more leverage because interest rates are lower than they've ever been. You've got a lot more speculative flows. I mean, you look at the lawsuits that are popping up against Robinhood for putting all the 30-somethings into option accounts that probably they don't understand. I used to work for a few years with my foreign exchange business with an option market making firm, so I know a bit about the perfect type of client order flow, and it's not the proprietary traders at Goldman Sachs. It's the mass affluent retail client who is not particularly sophisticated. So there's been a transference of wealth going on there. There are a number of things that are deeply worrying, and yet, if you think about the government's position, both in the US and more so in Europe, now is the time to issue an enormous amount of debt because it will never be this cheap again. And therefore, in order to get their economies going, the easiest, the least painful way of doing things is to saddle our grandchildren and great-grandchildren not yet born with the obligation of repaying that debt, which they can issue with coupons of under 1%.
Are you referring? Sorry.
Yeah, it's probably the way ahead, as long as the governments are there with that kind of fiscal put, taking over from the Greenspan put. It's now the fiscal put. Liquidity is flowing into the markets. The savings rate continues to be elevated. Consumer prices remain muted because people aren't going to be spending rashly. But that excess liquidity will continue to flow into financial markets. So it feels like a Ponzi scheme, but as with all of these things, it's always very difficult to know when the day of reckoning is going to come. A lot of people in late March and early April of last year were predicting much greater falls in the equity market. In came the Fed, in came the fiscal stimulus, and turned it all around in incredibly short order. Part of the reason for that is everybody had seen what happened in 2008 and knew this was a 2008 redux, except it was done with more panache. They threw infinitely more money at it this time and made much bolder promises, and they turned everything around. Now, there is a time where you have to pay for that, but if the 10-year is yielding in the US, around 110 basis points, now is not the time to be raising taxes and getting the house in order. Now's the time to just go and borrow another, 5, 10, 15 trillion dollars in the bond market and see how much it takes to break it.
Absolutely. Colin, I wish we could talk for many, many hours beyond this, but for the sake of time, because you have a lot of information on you, we got to end it here. But before we do, can we know specifically where can our viewers, view your work? I know all the info is going to be down in the description below, but if you'd like to add anything else.
So my website is inthelongrun.co.uk, and there you'll find the relatively regular newsletters. I have another day job which has kept me increasingly busy of late, so I don't write as many of these as I used to. thankfully, they're all a little shorter. I think I averaged about 3,000 words in my original letters. I'm down to around about 1,500 words now, which seems to be more pleasantly received. So please do feel free or reach out to me via LinkedIn. I'm an avid user. I also have a LinkedIn group called Macroeconomics and the Markets, which is free to join. But please do feel free to join the debate. The more discussion, the better, because I think economics is not solely about having a very good mathematical grasp of things. Different people from different places around the world bring something to the conversation every time. Some of the most interesting and original things. Guy today was talking about sequestration of renewable energy into hydrogen. Of all places, in Iceland. You think that might have been more likely in somewhere like the Middle East, but fascinating conversation that I'm having with that guy. So there you go. Max, thank you very much indeed for the opportunity. And please come and visit me on my website.
Absolutely, Colin. I really appreciate you coming on again. And thank you, everybody, for watching.
Thanks a lot, guys.